Hello again, everyone, and welcome to today's webinar focused on the new tax legislation and its implications for companies growing by mergers and acquisitions and divestitures. As most of you know, the M&A Leadership Council is a unique group of professional service firms who join forces to give back to the M&A community by sharing their expertise through the many training programs that we now offer. Today's webinar is no different. Let me introduce my friend and one of our key speakers at our due diligence events, Michael Williams. Mike is a managing director of tax and transaction services at BDO and will be featured at our upcoming Art of M&A due diligence program in Orlando. People who know BDO, and we're about to know a lot more about today's hot topic. Welcome, Mike. Why don't you take it from here?
Thank you very much, Jim, and it truly is a pleasure to do this for the Council and for all of its members. This is a very exciting time for tax change. As many of you can well imagine, we've heard so much about these changes in papers, through the media, and tax people are busy trying to figure out the changes. I think back to the time when the legislation was passed and the President, the Speaker of the House, and the Chairman of the Senate Finance Committee lifted up a card for everyone to take a look at. And that card was to be the simplification of the Tax Act so that everyone could file a tax return on a card that simple. But it is anything but the case in the case of business taxation. Tax simplification, this is not for our M&A deals. What we hope to do here is to do some sky-high lights for you on the modifications that the tax reform or tax overhaul has brought about for the M&A world. And we're only going to cover those that we think are applicable to mergers and acquisitions. So what we would like to do is think of this in terms of dividing up our tax changes among domestic deals that happen in the United States and then cross-border deals. And then how all of the combined impact of those changes really need to be considered in deals, not only for this year, but for successive years, because the changes go into effect and are already in effect for 2018, which means that we all do need to address them as soon as possible in connection with our deals. So here's a highlight of what it is that we'd like to cover in our session. First, just to level set an understanding about what tax structuring involves and a little bit of an understanding about asset deals versus stock deals. We'll cover that really quickly in terms of what the advantages and disadvantages are so that when we begin to cover the changes for domestic deals and cross-border deals, that the table will be set for everyone. Then we'll provide some observations and viewpoints about the tax changes and what deal makers really need to be considering at this time. And then we'll close off with some best practices for deal makers to address some of those changes. So very quickly, as a primer on asset deals versus stock deals, we all are familiar with the fact that we need to make that choice as to whether we should have an asset deal versus a stock deal, and it comes down to non-tax reasons often. An asset deal really is a pure transfer of assets, and it could include some transfer costs that are significant, and we need to keep in contact or in mind what that could involve from a complexity standpoint in getting the assets transferred. Whereas a stock deal can be a little bit easier. the assets and the liabilities come over when we buy stock. The advantage of the asset deal is that we can acquire certain assets and exclude certain liabilities, whereas in a stock deal, that's not the case. So in terms of how this plays out in from a tax standpoint, what happens in a stock purchase is the buyer, whatever the buyer pays for that stock, ends up being the tax basis that it takes. There is no step up in the tax basis of the assets for which the stock was purchased. But if the company does have tax attributes such as net operating losses and credits, they can carry over, subject to limitations on their use. And the new Tax Act has something to say about all of this. The disadvantages are that the buyer also assumes the pre-closing tax liabilities. In a stock sale, the seller has certain advantages and disadvantages in that the seller doesn't have to really consider having to pay what we call a double tax. That is to say, there's a single tax on the sale of the stock, and it's generally at capital gains rates, and that's great news for the seller. And the seller is very much incentivized to sell stocks in connection with their deals. In an asset purchase, the buyer favors it often because of the ability to step up the tax basis in the assets, and if there is such a step up, they'll be able to take future tax deductions, which had not been available before that to the seller, but the tax attributes don't carry over. And as far as the seller is concerned, the seller has to deal with double taxation. You see that point down below. The disadvantage is that not only is there a tax that needs to be paid on the sale of the assets, but the shareholder also is taxed when the proceeds are distributed, which makes these deals very expensive for sellers who are in the form of a corporation. So what do we need to know about some of the key domestic tax changes and how they're going to affect tax structuring, or how they're going to affect deals like the ones that we just described? Well, the first and probably most important change that's been made and that everybody's familiar with is that there was a push to align the U.S. tax rate, corporate tax rate, with the world tax rates in general. So there was a huge drop in rates from 35% to 21%. And that has been a very significant development for deals. So from the standpoint also of tax attributes, if there was a sale of stock, then net operating losses in the future that could be carried over to the buyer for future use will have more limitations on the ability to use them. One, for example, is there'll be an 80% limit on the ability to use net operating losses 4 years going forward for NOLs that are carried forward from this year onward. And also significantly, the carrybacks, the ability to carry back net operating losses has been repealed. And that can have a very big impact on deals. And that is to say, usually transaction costs are looked at by the seller and by the buyer sometimes. They can be significant in terms of their tax value in that they create an NOL that can be carried back into prior years and used to obtain valuable refunds. Well, going forward, that's not going to be available anymore, and so it's going to diminish the value of those kinds of tax assets to obtain a very quick and valuable refund in connection with those transaction costs. A very significant change. Another change that could have, we've talked about the tax the tax changes being a reduction in tax rates, in other words, lowering corporate tax rates. But at item number 4 on the slide, there are interest expense limitations that have been put into effect now. And as you can see, there is a limitation on the ability to deduct interest going forward. So in deals that are happening now, buyers really need to consider whether or not their financing is really the way that they need to go with respect to the deal. So 30% of the interest that a taxpayer has may be used to offset income in the future, and it's defined. The income that's defined is sort of a modified number that's based on EBITDA, and then in future years will be based on EBIT, which is even more restrictive. So that will have a very big impact on deals, and this is an area where where acquirers really need to focus. One other area of great significance is the change that deals with immediate expensing of assets that are put into service in this year and going forward. So there's the ability for CapEx. There's the ability for our for companies to take an immediate deduction for those amounts in the year in which those assets are placed in service. Now, this is phased out over time, but right now it's going to be a 100% ability to do that. What happens, too, this has been expanded to acquisitions themselves of tangible property, of certain qualified and defined tangible property. But it happens to be in the nature of equipment and those kinds of property that, that are part and parcel of running the business. So it does not include intangible assets, so there's not an immediate write-off for intangible assets, but it does apply to tangible, and that is a great benefit for companies that are involved with asset deals. This would not apply to stock deals, but it does to asset deals. The other change I wanted to point out is the increase of the use of the cash method. I think we'll see more companies, more corporations that will be using the cash method than in the past, because now companies may be able to use this method up to $25 million of gross receipts. Prior to this, it had only been $5 million. And so expect that your targets, the target companies, are going to have more use of the cash method in the future. And I think that that's going to bode well for many service industries too. But this is a really good development for businesses that want to defer income. What it means for acquiring companies is that they're going to have to come off that cash method and go to the accrual method, and that can be an expensive change for the parties who are involved. Last 3 changes on the domestic side that I wanted to point out is that people have heard a lot about the pass-through changes. That is to say, if someone owns an S-Corp, an LLC, a partnership, that there's now a lower tax rate that applies to the income that flows through to individuals who own that enterprise. Subject to certain restrictions, that 20%, that's achieved by using a 20% deduction for this pass-through income. And it ends up having an effective tax rate of 29.6%, which is a much lower rate than what used to be, in effect, close to 40% for individuals who owned these enterprises. So there are a lot of conditions associated with this, but the point here is that companies should really be thinking about the right choice of the right entity that they want to have going forward, either when they form themselves, to acquire companies, or with regard to the acquired entity and going forward with it. Something for your HR department and for your benefits people is that the compensation deduction cap, the $1 million cap, and I hope that you may have been familiar with the fact that that had applied in the past, that its application has been expanded. So what this means is that if you have a deal and there is, and you have change of control payments that occur in connection with the transaction, if your key executives, the top executives receive $1 million or more, or actually more than $1 million in connection with that change of control, then the target company, the people as to who the executives work, cannot take a tax deduction for the amount in excess of $1 million. And that would come up more often than we think. The reason why this is important is because the definition for compensation subject to the cap has become more expanded and more inclusive. It now includes stock options. It now includes performance-based compensation. So we should see this coming up more often. We've heard of the golden parachute rules. This is different from that, but it operates in connection with it, something to keep your eye on in a deal. Also, we've heard a lot about financial buyers who have owned companies that they've acquired and have been able to take advantage of capital gains rates with respect to their carried interest. That rule was put into place by Congress, the last point there, where a 3-year holding period is now required in order for the financial buyers to be able to obtain capital gains treatment on the sale of a company after they purchased it. So let's move on to some of the key cross-border tax changes that have arisen since the Tax Act, which applies again with regard to all of these changes in the year 2018. And the general milieu here now is that the system that we use to tax worldwide income has changed. We've gone from globally taxing income for corporations in the United States, and one which had the ability to defer the taxation of some of that income, to a system that is more territorially based, but it's really not fully territorial. It's really a quasi-territorial tax system. So this is really important because this is really changing the way that the target companies or our acquiring companies need to consider those target companies in terms of any cross-border transactions going forward. So one of the things that Congress did, and I think we're all very familiar with this because this is in the news, we have a company like Apple with $150 billion of earnings overseas that they want to bring back under this provision. It's a transition tax on earnings for non-U.S. subsidiaries. So U.S. companies can repatriate the cash that they have piled up overseas at a very low rate, and then there'll be a higher rate on other assets. This tax can be a lower rate on other assets. That, by the way, that should be 15.5%. My apology on that slide. Okay, and there's a lesser rate on cash that's been invested in other assets overseas. I just saw that. Okay, so also what's good about this is that a company can elect to pay that over 8 years. Why is this important? Well, it's because when we're acquiring companies, they may have elected to take advantage of this transition tax, and it's going to mean that we need to understand what kinds of earnings they had built up overseas for tax purposes and whether they got the tax liability correct on that. So there are a lot of companies out there who have already released earnings taking into account the impact of these changes, and they've already been through these calculations, but some target companies may not really fully appreciate what's involved with this, and there's quite a lot of work to be done, and so this would be a key due diligence item going forward. Another way of making this system more amenable to being a territorial system is that dividends that are received from non-U.S. subs are now available for 100% deduction. So that eliminates or provides an incentive to not have a deferral at all. Money can come back into the U.S. freely. Now, these are three regimes. I'm not going to spend much time at all with them, but I just wanted you all to be aware that they are in place and that these are designed to encourage our companies and those which we're acquiring to make sure that to be incentivized, let's say, to generate income in the U.S. And to the extent that they're pushing income offshore and generating income offshore, that these taxes really are going to be providing something of a minimum tax on those activities. So we'll need to keep those in mind as due diligence items as well going forward and in planning when we're acquiring target companies that are multinational. The two taxes I'm referring to are the global intangible low tax income, the GILTI tax, and the way I like to describe that to our clients is that it is guilty. It's income for tax purposes until it's proven not guilty. So everyone really needs to keep an eye on that as to whether or not they're generating that kind of income and whether or not that's going to generate a minimum tax. And then there's the base erosion and anti-abuse tax, which is also a minimum tax. The one incentive, though, that also is derived is point number 2, where this incentive is designed in the way that some regimes have existed in the past for the U.S. for us to export our products and services, but to make sure that that what we're doing is we're doing it in a way that we are deriving foreign source income, but that those products and services are being made in the U.S. And that incentive provides this effective tax rate of 13%. That's important because this is going to be used by targets. It's probably already being implemented, and we're going to want to make sure that they meet those requirements. Okay, so I'd like to just make a few observations about the changes that have happened and how they are affecting deals. First and most importantly, these changes are really going to affect how deals are structured, how they're valued, and how they're financed. So, for example, at our firm, our valuation area has spent a lot of time with respect to the modeling that they are designing for the new tax rates. Also, these interest limitations, the way that they affect how capital is used in deals, means that the after-tax value of using interest deductions has been minimized by two things. One, by the interest limitation, and two, by a lower tax rate. So the fact that interest expense is not as valuable is making corporations, acquirers, and others to reconsider how they would like to capitalize their acquisition. So really important fundamental changes are going on right now in the deal area, and really this is going to affect everyone involved with your deal in terms of organizing the approach that the company would like to take from a financing standpoint. The reduced tax rate that we've talked about, we mentioned how it could affect the benefit associated with interest deductions, right, because a lower tax rate means less of a deduction. but it's also going to affect the present value benefit that is associated with stepping up the basis in assets and taking tax deductions in the future, or using NOLs going forward. The tax rates are just going to be lower, and therefore there won't be as much of a benefit to using those items. And there are also these tax receivable agreements out there where parties agree to pay for the benefits of using the benefits that they've acquired from a target company. So all of these need to be sort of remodeled, reevaluated, reconsidered in connection not only with deals that are happening, but with prior deals to think about whether there's any application. But it's primarily applicable, this is all applicable to current deals that are happening in 2018 and going forward, and prior deals are not as directly affected. The reduced corporate tax rates may also increase the earnings and cash available that corporations have to make acquisitions. And the last point on this slide, dealing with the lower tax rates here in the U.S. and the incentive not to offshore income that I already mentioned, really seems to indicate that structuring deals in the U.S. might become more likely, or the use of debt overseas might be more likely because of the benefits of using it overseas than it would be here in the United States. The interest expense limitations also may operate to increase taxes for many corporations, financial buyers who highly leverage their deals and think about management buyouts, that the benefit will not be as great. Those carried interest provisions should not affect many private equity deals. Their holding periods really tend to be much longer than 3 years. And also, because of the certainty that the provisions have given us, there's now a better operating framework for us to do deals. In 2017, there were many deals placed on hold because we didn't know what the outcome may have been under those tax rules as compared to the uncertainty of what we didn't know that was going to happen in 2018. But now that we know, we are in a position to accelerate those deals. We'll know what their outcome is going to be. But it's also, as you see in that last point, a lot more complicated now. I can't emphasize this enough that this didn't provide a total change to the tax system. What it did is it just added to it, and many of the same rules are still in place from prior years. It's just that these have modified them. So I'd like to wrap up with some of the best practices that you, as deal makers and as people at your company, should keep in mind when we're thinking about addressing these recent tax changes in deals. We mentioned considering the choice of entity and how you're going to finance the deal. So we also want you to think about reevaluating deal models and the assumptions that you're using in them. Consider the effect that the changes are going to have on your deal documents. There you're going to want to coordinate with your legal areas and others who have input on the deal documents. And then also, I've mentioned just a couple of items where we really need to think about changing the scope of the tax due diligence that you perform in this year and going forward on your targets. And then one final nugget, if I might, and that is I really think that the changes here are going to place more of an emphasis on asset deals than on stock deals. And that's because the tax rates are lower for the seller now. And there are now opportunities for the buyer to immediately expense many of the tangible assets that are acquired in the year of acquisition.
Mike, I think that's a great point. One of the first questions that come to mind that I'm hit with a lot by people, and maybe more from folks who aren't as deeply involved in this as certainly you are and BDO, but this repatriation of dollars, like you just mentioned, the Apple organization bringing $150 billion back to the U.S. And there's a lot of discussion around, obviously, the payout of bonuses and minimum wage increases and all those other kinds of things. But in the simplest of terms, what are your thoughts on the impact of that in terms of M&A activity in general?
Jim, great question, and I think it's going to increase M&A activity. I think that there will be more cash available as a consequence of bringing back earnings from overseas to repatriate that. And I've, seen, that there have been statements made by CEOs at many corporations that they do intend to make capital expenditures, but also to grow not organically, but through acquisition. So yes, I think it's going to have an impact on the frequency and the amount of deals that we're going to see this year and going forward.
Yeah, I think so too. Well, listen, Mike, thank you very, very, very much for this time. The information is excellent. Everyone out there can see why BDO is such a great partner of the M&A Leadership Council. But I want you to go from this presentation to thinking about joining us in Orlando in the near term. We have an event out there called the Art of M&A Due Diligence. It will feature Mike and the rest of the BDO team, not only in the tax area, but clear across all areas of due diligence and transaction management. So, Mike, again, thanks, and we look forward to having another webinar soon with BDO and featuring BDO. Everyone else, please have a great day.